Welcome to Business Reporter's Best of British campaign. Traditional real estate investment has become increasingly risky. Offices and shops, for example, used to offer stable returns for those seeking to channel capital into property. But the changes to the real estate market over the past decade have diminished their appeal, and the COVID-19 pandemic has only accelerated the trend. Yet new opportunities have arisen in their place. Offices might no longer hold the same draw for real estate investors, but what about the various non-traditional uses whose importance has increased, such as care homes and student accommodation? Could they soon become the go-to property for investors? And if so, how can investors pivot in the direction of this underexplored niche with the retail estate landscape? To discuss this, I'm joined by Michael Walton from Rynda. Good morning.
Good morning.
We've seen tremendous change in the real estate market over the last few years, and in particular in the last 18 months with the COVID-19 pandemic. Could you give us an overview of how those changes have manifested themselves, and also where the industry is right now, and in particular what those changes in the last 18 months have actually done to the industry?
You're absolutely right. There's been huge change, and COVID-19 has accelerated those changes massively. It's left a lot of confusion. People do not know where to invest in real estate at the current time. The traditional asset classes, as we've seen from what's been happening on the high street, whether it's Debenhams closing, more and more shopping going online, or indeed what's been happening in the office market with people working from home. It's very difficult for real estate investors to know where the future lies because the traditional areas where they've invested, they just don't feel comfortable going forward.
Now, you talk about, Debenhams, you talk about offices changing. Who's been impacted by that the most, by this traditional area of real estate changing so much?
Well, obviously, as we see, on the news, people are made unemployed because they've been working in these shops. The business owners are seeing their income disappear or their businesses fail. But it also affects everybody else in a different way, and that's into their pension funds, because their pension funds will be partly invested in commercial real estate. So it's affecting the trustees because they're trying to work out what they do going forward.
We talked in the introduction a little bit about the alternative areas of real estate that people are investing in. Can you give us a bit more detail about that? And we understand probably what's brought about that change, but how that change is actually taking place.
Well, that change is taking place because other uses of property are now becoming more high profile. So, for example, I'm sure many people have driven over the Queen Elizabeth Bridge to the east of London. Well, that is in an infrastructure fund, and the revenue from the tolls goes to pension funds, and somebody owns that bridge. So that's an alternative real estate asset class, but there's a whole range of other ones which are now being explored with far greater urgency to try and replicate what the traditional real estate asset classes will have achieved for pension fund investors in the past. And that is largely a little bit of rental growth, income and rental growth, and ultimately, hopefully, a small amount of capital gain at the end of the investment period.
Tell us a little bit more about Rynda, who you are, and how you were able to see these new opportunities.
Rynda is a business that's 16, 17 years old. It's all owned by senior management. My personal background, I'm a qualified chartered surveyor by training, had the pleasure of working at places like Lazard Brothers and Citigroup. And we've always been a business that has been looking forward as to where we felt real estate was going over the next decade or two. And then we have looked to work with investors that, if we do well, they tend to want to repeat invest with us, and then channel some of that capital that is being generated through pension funds into what we think are the most appropriate real estate classes going forward for the next decade.
And how do you actually work with clients? So let's say I'm an investor, an institutional investor, and I come to you and I'm interested in investing in real estate. What's the process? How do we actually work together?
Well, it's largely if you in face-to-face meetings or more recently Zoom, but making contact with those investors if they're not existing clients, talk a little bit about the business, talk about the type of diversity in the senior management team, the type of research that we do, talk a little bit obviously about our track record, but basically paint a picture for them as to why we feel certain asset classes or certain areas in the real estate market will generate the type of returns that they are looking to achieve over that next decade. So it's driven by research on our own type of analysis of what that research is telling us and what that's going to transpire into real estate investment.
People will always be interested in any form of advice, but where that advice is coming from. So they'll want to know what's different about Rynda compared to anybody else who's offering the same promise to make good returns from real estate investment.
I think the fundamental part about Rynda is that we are very focused at research. We look at the whole range of different areas that we can pick up data from. So we have access to databases that have an in-depth analysis in each postcode of the makeup of the population, how that is structured in terms of the different ages that people are in. It's looking at the different types of housing that people are in, and that then helps us form a view as, for example, whether a care home is likely to be successful in that particular market. It will also form a view, clearly with student numbers, and obviously the UK it has a very large export of education with a number of students that come to this country, and indeed our own domestic students. So we've got the data as to how many students there are in each of the universities, the breakdown between overseas students and domestic, the breakdown of postgraduates and undergraduates. And that all helps form the view as to whether a purpose-built student accommodation block is going to be successful. It forms a view also as to whether the individual pieces or those types of accommodation within that block should be more focused at studios or more at clusters, because there is a different demand between postgraduate and undergraduate as to those different formats of property.
Many people might say that this is actually quite risky. You're going from what is considered to be quite a traditional, well-known and well-understood real estate area to something that's a little bit more unknown. What would you say to people who are nervous of the kind of risks that you're taking?
Well, I think that they should be asking of their investment managers, how much do they really know of these risks? How are these risks going to be mitigated? And risks can be mitigated through a whole variety of different ways. There may be, for example, in student accommodation, to buy a block that has been effectively nominated to a particular university, where the university is the tenant, they take a long lease. It may be that we would suggest that actually you want to do direct lettings in a particular market because it's very strong. So there are ways to mitigate risks in these different asset classes, but fundamentally the trustees of the pension funds and investors should be asking of their investment managers, how have you got to the conclusions you have? Be clear with us what those risks are, and be clear, are we getting compensated if there is additional risks for the returns that we're looking to make?
And what are the consequences of greater investor awareness? Because we all know that it's all about timing when you get involved in any form of investment. So, looking at the investors themselves, looking at the real estate itself, what are those consequences?
One of the big ones in the alternative space is that the individual universe of student accommodation, for example in UK or France or Germany, is fairly finite, and that pool of investment opportunities is probably a lot less than the traditional asset classes of offices or industrial or retail. So the risk that comes of that greater focus is somewhat of herd mentality. Everybody will then decide to focus their efforts, new asset in allocation towards these alternatives, and that greater volume of demand drives up prices very quickly, and then there's a risk that the new investors are coming in too late in that cycle. So for Rynda, we are very comfortable co-investing with our clients. We've got a very big interest to make sure that we're saying, stop, We think this market is now getting to a point that we don't feel comfortable with that additional investment, and we'll stop and we'll move on to something else and maybe wait 18 months for that to pass through, and then comes back to that knowledge, back to that market with the knowledge that we've gained.
We know that there has been tremendous change already in the real estate market, and we know from what you've been saying what's happening right now. What about the future? Let's say if we scrolled forward 5-10 years, although we don't expect you to be able to look into a crystal ball, what are the kind of trends that any potential investor should be looking at?
I think the one thing I would say to a real estate investor is really focus on demographics. What the age at which people are dictates what they want to do with property. You know, it's quite clear that a greater proportion of over 85s will actually ultimately have demand of a care home. If there's a big number of 18 to 20-year-olds passing through society over the next decade, that's probably extremely good news for student accommodation. So I think there's a huge focus on looking at demographics, and I think a number of real estate investors haven't really put that at the centre of their strategies. The second area that I think is very important is type of ESG matters. The environment, what use is your property having, or what impact is your property having on the environment? And the underlying investors, be they pension funds or stock exchange investors, are increasingly focused at only investing in investments that really suit where they are in terms of their appreciation of environmental damage. So I think that is a very, very important area, and that is what's going to maintain and perhaps drive property values going forward in terms of its environmental credentials.
It's been really interesting finding out more about the real estate market, but particularly interesting to see those changes and those trends that we should be looking out for in the future. Michael Walton from Rynda, thank you very much indeed.
Thank you very much.